Can you predict the stock market? It's probably the biggest, most asked question in all of finance. So in this explainer, we're going to dive in and break down 4 major strategies that people have used to try and do exactly that. But that brings us to the real question, right? Is it actually really possible to see where the market is headed? It's the one thing every single investor, from the pros on Wall Street to someone just starting out, wants to know.
You know, when you really think about it, the whole challenge of investing boils down to just 2 numbers. You've got the price you pay for something today and the price you're going to sell it at someday in the future. Easy, right? Well, the problem, of course, is that that second number is a total mystery. So, how do we even begin to guess?
All right, our first approach is probably the one that feels the most natural to a lot of people. It's all about seeing a trend and just, well, riding the wave.
There's this old saying on Wall Street, don't fight the tape. And what it really means is, if something is going up, assume it's going to keep going up. If it's going down, assume it'll keep going down. The core idea is that a trend is more likely to continue than it is to suddenly reverse. So don't be a hero trying to bet against it.
Now, this strategy, it's not just about charts and numbers. It's really about human psychology. It's all rooted in behavioral finance. You know, the classic drivers, fear and greed. When the market is doing well, people get excited, and money starts pouring into things like mutual funds. All that new investment, well, it pushes prices even higher. And what does that do? It gets even more people to buy in. It creates this powerful feedback loop that just feeds on itself.
And you know what? There's academic research that actually backs this up, but only to a point. A really famous study showed that stocks that have done well over a 3 to 12-month period, they tend to keep on winning. But, and this is a huge but, other research found the complete opposite over longer stretches. Stocks that were winners over a 3 to 5-year period actually tended to underperform later on. So what on earth is going on here?
Well, that strange reversal brings us perfectly to our second big theory, one that tries to explain exactly that, the mean reversion theory.
So, what is mean reversion? It's this idea that things like stock prices have a long-term average they like to stick to. Think of it like a rubber band. You can stretch it way out in one direction, but eventually it's going to snap back towards the middle. If a stock shoots way up, mean reversion says it will eventually drift back down towards its historical average. And of course, the same thing happens on the downside.
But here's the catch with this one. While it sounds great in theory, it is incredibly difficult to use in the real world. Researchers who studied this found that if it exists, it's a super slow, almost invisible force that plays out over many, many years, sometimes even decades. It is definitely not something you can use for short-term trading signals.
Okay, so we've got one theory for the short term, another for the long term, and they both assume that past prices matter. But what if they're both wrong? Our third theory asks a pretty wild question. What if the market is just completely random?
This idea comes from some pretty serious brainpower, a Nobel laureate, in fact. It suggests that market prices follow something called a Martingale. Now, in a Martingale series, the absolute best prediction you can make for tomorrow's number is, well, today's number. All those past trends and wiggles on the chart, they're basically meaningless for predicting the future. A simple coin toss makes this really easy to understand. Okay, imagine you've got $50 and you bet it all on one flip. You could end up with $100, or you could end up with $0. But if someone asked you to make your best statistical guess right before the flip, what would it be? It would be the $50 you started with. That's a martingale.
The popular way to describe this is a random walk with an upward drift. The idea is that day-to-day the market is pretty much random, but over the long haul it tends to trend upwards. Now, if this is true, it changes everything. It means investors should probably stop trying to outsmart the market and instead just focus on managing their risk.
But there's one final, really big school of thought that we have to talk about. It says no to predictable trends and no to pure randomness. Welcome to the world of value investing, the art of hunting for bargains.
See, value investors have a totally different belief. They don't think the market is perfectly efficient or random. They think it makes mistakes, a lot of mistakes. They believe the market sometimes gets it wrong and underprices really good companies. So their entire job is to find these little glitches in the system, to buy assets for less than they're actually worth, and then wait for the market to realize its mistake.
So how do they actually do it? Well, as you can see here, they're digging into valuation ratios. They're looking for low numbers. A low price to book, or P/B, might mean the market is selling the company's assets for cheap. A low price to earnings, or PE, might suggest the stock price hasn't really caught up with how much money the company is making. And I've got to tell you, decades of research has shown that over the long term, this strategy has been incredibly effective.
All right, let's take a breath. We've looked at 4 really powerful, but also kind of contradictory theories. We've got momentum, mean reversion, the random walk, and value investing. So, after all this, what's the actual answer? Which one is right?
Well, the honest-to-goodness answer is that even after decades of study by some of the smartest people in finance, nobody has a single solid answer. It's elusive. What we can say is that there really does seem to be some kind of short-term momentum effect, and there's also some evidence for that slow, long-term mean reversion. And yeah, those valuation ratios like PE and PB, they definitely seem to matter for future returns, but they've never been precise or reliable enough to be a perfect buy or sell signal.
So, where does all this leave us? If the experts can't even agree on one single way to predict the market, what are we supposed to take away from all this? Well, maybe the goal isn't to predict the market at all. Maybe the real goal is to better understand ourselves. Each one of these theories, it taps into a certain psychological bias, a certain way of thinking. So the real question might be, which one of these biases is driving your decisions?